Hello, everyone. I'm Mehmet Tuncer, and I'm a principal in the investment team at Coller Capital, based in London. Let me start by thanking you for making the time to join us for our Barometer webinar. I'm joined today by one of my colleagues, Roseita Monteiro, who's a principal in our investor relations team based in New York. Together, we will present the results of our latest Barometer. Throughout the session, you will have the opportunity to submit questions. You can do this by using the Q&A button on the right-hand side. Please kindly share your contact details so we can follow up with our response directly. Coller Capital's Global Private Equity Barometer is a unique snapshot of worldwide trends in private markets. It's a semi-annual overview of the plans and opinions of institutional investors based in North America, Europe, and Asia Pacific, including the Middle East. This 39th edition of the Barometer captured the views of 110 private equity investors from around the world. They were surveyed over a period between the 19th of September and the 3rd of November 2023. Its findings are globally representative of the LP population by location, type of organization, total AUM, and length of private equity investing experience. Whilst the tough conditions seen during H1 23 have continued through the remainder of the year, the results show that, despite uncertain times, investors remain positive on private equity and are being selective on the strategies and sectors they invest in. Since our summer 2023 barometer, we've seen the halting of interest rate hikes, decreased inflation, and continued low unemployment. Economic growth has been positive, but slowing as the impacts of higher real rates start to show. With that background, let's now turn to our first finding, which looks at the growth of M&A across private market managers. Almost 3/5 of LPs see M&A increasing over the next 3 to 5 years, with European LPs expressing strongest support for this notion. High interest rates, fundraising challenges, and increased regulatory costs could be potential factors shaping LP perspectives. This could lead to further consolidation, given there are roughly 15,000 private market managers across the industry. AI and machine learning has been one of the breakout stories of 2023 as ChatGPT and other tools went mainstream. Businesses and individuals alike are grappling with this technology and how it will impact their lives. We found most LPs have yet to integrate AI across processes within their businesses. However, 1 in 3 have plans in place to roll out AI tools within the next 2 to 3 years. Fund monitoring and competitor benchmarking appear to be the areas most suited to AI assistance. Whereas perhaps unsurprisingly, LPs see AI less suitable for investment decision-making. From a geographic perspective, European LPs are most likely to integrate AI across a range of processes. Our next finding further reinforced LPs' views that AI and machine learning is here to stay, with 54% acknowledging the need to develop greater skills in-house to enhance their organizational ability. A similar number of LPs saw sector expertise as an important specialist area to develop. The final AI-related finding highlighted LPs' appetite for investing in AI-focused funds. Nearly half of LPs reported interest in venture funds specifically targeting AI investments. European LPs displayed the strongest investment appetite across both VC and PE AI-focused funds. The profound investor interest towards AI expressed by respondents supports the wider trends that can be observed across global AI VC deal activity. According to PitchBook, in 2023, year-to-date, $7.9 billion was committed to generative AI startups by conventional VC investors, potentially on pace to match 2021 levels. When we widen the aperture to look at LPs' views on the recovery in VC investing in general, we found that while LPs don't foresee VC activity recovering in the next 12 months, they did show a greater display of optimism over the next 1 to 2 years. LPs are most bullish about the recovery in VC activity in North America compared to the rest of the world. The anticipation of future VC recovery might indicate an adjustment in investors' valuation and risk-return expectations as they adapt to the current macroeconomic conditions. Turning now to LP's thoughts on the proposed reforms by the SEC presented earlier this year. An overwhelming majority of LPs are in support of the SEC's proposed new private funds rules and anticipate they would have a positive impact on transparency and alignment. In particular, LPs believe the restricted activities rules, such as GP clawback disclosures, will lead to enhanced transparency. While the data was consistent across most LPs, there was distinctly less support for the rules from the larger LPs overseeing $20 billion and above. Our next 4 questions examined LP changing appetites to co-investment, continuation funds, and GP staples. We found 1/5 of LPs have increased their interest in co-investment opportunities over the past 12 months. This was more than double the number of respondents who expressed a reduced inclination to engage in the strategy. Perhaps in line with this changing appetite, we found that half of LPs surveyed are anticipating greater co-investment deal flow from their GP relationships over the coming 12 months. This shift in appetite could be attributed to greater LP sophistication in the selection of investment opportunities, more favorable information rights, and control in co-investment deals, as well as a potentially growing aim to commit funds to previously under-allocated strategies. When we explored continuation fund appetite, 4/5 of LPs say they will continue to evaluate opportunities offered by GPs on a case-by-case basis. The remaining 20% cited liquidity requirements as the reason why they're likely to do fewer continuation funds over the next 12 to 18 months. GP-led transactions have grown enormously over the past decade, and today represent roughly 50% of the secondaries market. While now a widely adopted investment route, around 4/5 of LPs are not prepared to invest in a GP-led investment that involves a stapled commitment to a new adjacent fund strategy. I'll now hand over to Roseita to present the rest of the findings.
Thank you, Mehmet. My name is Roseita Monteiro, and I am a principal in our investor relations team based in our New York office. Given today's highly constrained liquidity environment, the Barometer next explored whether LPs were happy for their GPs to flex their investment strategy in order to deploy dry powder. For year-to-date 2023, Bain & Company estimates there's around $4 trillion in the system, with buyout funds making up $1.2 trillion of that figure. We found that 2/3 of LPs were reluctant to allow this style drift, with North American LPs displaying the least willingness to see their GPs adjust their investment strategy. On the topic of liquidity, or lack thereof, we asked LPs whether distributed to paid-in capital, or DPI, had become the most important measure of performance. While clearly this is a widely used data point, just 15% believed it was the most important measure. Over 4/5 of LPs believe money multiple and IRR are the most important performance measures. Every barometer, we ask our LPs how they expect their target allocations to change over the next 12 months. More LPs are planning to decrease their real estate and hedge fund exposures than increase them, while almost 50% of all LPs are planning to increase their private credit allocations. Private credit AUM has been growing consistently through the last decade, with fiscal year 2022 assets under management of $1.5 trillion according to Preqin, which also estimates that by 2028, that figure is expected to reach $2.8 trillion. Given this remarkable growth, we explored the topic in a bit more detail with our LPs. Firstly, we inquired about the impact of higher interest rates on the performance of private credit portfolios. Nearly half of LPs reported that the current interest rate environment has positively impacted their performance versus around 20% of respondents citing a negative impact. This is perhaps unsurprising, especially for investors that may have larger exposures to floating rate instruments, which could lead to strengthened returns in higher interest rate environments. Next, we asked LPs how they expect the relative activity levels of banks and private credit managers in providing finance for private equity transactions to change over the next 1 to 2 years. 3/4 of LPs anticipate private credit managers will increase private equity lending at a faster pace than banks over the next 1 to 2 years. Just 5% of LPs see banks outpacing private credit managers. As traditional lending activity remains relatively curtailed, it could provide continued opportunity for private credit managers to take a larger share of the market. Recognizing that many LPs have been starved of distributions lately, our final question in this segment looked at whether borrowing to fund new commitments was a viable approach over the next 1 to 2 years. Likely given the interest rate environment, almost 90% of LPs were not prepared to embark on this approach. Much has been said about the opportunity presented by private wealth investors in the past 5 years. Historically, LPs have remained skeptical about how much capital this channel really represents as a proportion of total capital. However, our findings suggest that 1/3 of LPs now anticipate private wealth capital across private equity to reach institutional levels eventually, with a further 7% of respondents expecting this to happen in the foreseeable future. Individual investors account for roughly half of all wealth globally, which is estimated to be between $275 to $295 trillion. Yet those investors represent only 16% of AUM held by alternative funds, according to Bain & Company. Looking now to Asia, where LPs are seeing greater buyout opportunities in Southeast Asia and India than any other market across that region. Since we last asked LPs for their views in the summer 2018 Barometer, more LPs are looking at Asia on a country-by-country basis versus a regional approach. The final segment of our winter 2023 Barometer looked at returns, both those achieved and future expectations. First, we asked about previous performance over the past 5 years. 4/5 of LPs have seen 11 to 20% annual net returns across their private equity portfolio in that time. This is a slight decrease from 2018 levels, when 85% of respondents achieved returns across the same range. Next, we asked LPs what annual net returns they expect from private equity in the next 3 to 5 years. Almost 60% of LPs expect to achieve annual net returns in the 11 to 15% range across their entire private equity portfolio within the next 3 to 5 years. Buyout is expected to outperform venture across the ranges and regions. LPs were also asked whether an element of their compensation was tied to the performance of their institution's private equity portfolio. 59% reported positively, which is largely the same proportion as when we asked LPs back in the summer 2018 Barometer. Sovereign wealth and government-owned organizations had very limited participation, whereas family offices were much more likely to be compensated according to their performance. Our final question tested LPs' thoughts on GP return expectations. 3/4 of respondents thought GPs are being too optimistic, and 1/4 found GPs to be realistic with their outlook for returns. That concludes our findings. Investors are telling us that over the next 3 to 5 years, LPs expect growth in M&A activity across the private market landscape. LPs are looking at AI to improve their operational and investment performance. Private credit continues to be a highly allocated asset class, with LPs expecting private credit financing to outpace bank lending. The majority of LPs expect their private equity programs to return within the 11 to 15% range over the next 3 to 5 years. The Barometer is a publication of the Coller Research Institute. You can find more information about our reports on the Coller Capital website. You can also subscribe to our future research publications on our website. Alternatively, reach out to any member of the Coller team, and we will arrange to send you a copy. That concludes our presentation. For those of you that have submitted questions, we will respond to you shortly. We would like to hear what you thought of the webinar. Please submit your feedback via the link on the homepage. Thank you very much for watching.